Hey everybody, welcome back to the Financial Freedom Show. My name is Rob Berger. And yes, for those keeping score at home, I am 2 minutes early. But I see all these great questions in the chat and I thought, well, look, I'm just sitting here. Let's get to it. So please give me a thumbs up in the chat if, you can hear and see me. So how's it going? I guess we get to find out, what kind of investors we are. I'm going to pull up my stock app here. Oh, it's all red except for my tips fund. It was up. Everything else, I'm pretty sure. Caterpillar was actually up today. Let me show you my screen. Here it is. This is just the Apple stock app. I don't own all of these, by the way. The ones that I own, and not everything I own is here. Basically, my individual stock. So let's see here. I like to tell you when my investments do well. So we might as well take a look at it when not so good. So Apple down 2.37%. Berkshire, I own the B shares, not all of them. I think Warren Buffett owns a few of them. Anyway, down 81 basis points. Wells Fargo, that was down about 500%, I think, today. Just 6.11%. Bank of America, 6.37%. I have a tax-exempt fund that I've tracked here. It's down 19 basis points. But this Schwab US Tips Fund, I mean, look at that, crushing it with 63 basis points in one day. Yeah, it's not fun. The S&P 500 was down 295, 2.95%. I'm just pulling up. Let's see here. If we go, I'm in Morningstar. I'll pull this up in a second. So here we are. I'm going to move my water bottle out of the way since folks were very upset with its placement last week. Okay, let's see. You're looking at the screen, right? Good. So we'll just use Vanguards as we could have used any of them for the most part. And let's see here. We have year to date. I want to try to find the date that they have. That's the analyst rating. I don't know if this is up to date. Oh, it's as of March 4th. See right here? It was down on a price basis. So this is an ETF. So there's price and there's NAV, right? So the price is what it's trading at. The NAV is the net asset value, the value of the underlying assets, stocks in this case, that the ETF owns. So you can see there's a slight difference. I'm looking at these numbers right. Whoops, this one, that's the price. It's down 9%, 8.99. The NAV is down 8.94. Let me see if I go to Yahoo Finance, I'll get a more up to date. We can just, we want to see all the red. We don't want to leave any red off the table. And let's see here. So we're on Yahoo Finance, and we'll go to. I don't spend a lot of time on Yahoo Finance. Here we go. Year to date. It's down 9.5%. So, I mean, as if we were to end the year down 9.5%, wouldn't be fun, but it wouldn't be the end of the world, right? And so there it is. In looking through the comments in the chat, great question. Well, let me get to one first, but then I want to get to the question about all of this. Andrew asked if in a target date fund, the expense ratio covers everything, or do you also pay the fees of the underlying funds? Because most target date funds, maybe all of them, are fund of funds. So like Vanguard's target date fund, it consists of, I think, 5 Vanguard funds. I may have the number wrong, but everyone that I've looked at, the expense ratio that you pay for the target date fund is what you pay. You don't pay an additional expense ratio for the underlying funds. All right, we got that one out of the way. Pretty sure that's right. So, Coke, I don't know how to pronounce the name, but they ask a great question. Do you think our investing careers will be over if World War III starts? And I guess by investing careers, maybe you're in the business, I'm not, but I guess our time as investors. And so we can't predict the future, right? But we can look at the past. I mean, investors, if you were a long-term investor, and let's just stick with the last century, You had, of course, World War I, which was just, if you've read any history on World War I, or maybe seen some somewhat realistic movies, I mean, it was gruesome. Investors, again, long-term investors survived the 1929 stock market crash. There were 3 years that it basically lost 90% of its value, followed by a Great Depression. And if that weren't enough, we topped it off with World War II at the end. We had the Korean War, we had Vietnam, we had the Cold War in and of itself, obviously difficult. We've had, 9/11. We had the Great Recession. I guess the COVID crash, although in some ways, we've all lived through it now. It lasted like a month, and then the stocks just took off. It almost seems like a walk in the park, right? So, the question, if you think about the question isn't like, will the stock market survive? That's not really the question. The question is, will there continue to be business? Will we continue to buy and sell goods and services, right? I mean, that's the question, right? That's I know when we watch the price movements each day, like I just showed you, and my stocks are down, there's almost a gambling or gamification of it in a way. I certainly don't intend that, but there's this sense that there aren't real live businesses behind these numbers, and there are, and that's true, by the way, not only the stock market but the bond market, right? Behind bonds are real live businesses, real live governments. They have expenses, they have income, and so I see no reason why that's going to come to an end. Now, that doesn't mean there won't be difficult times. As this goes so far, it's not that difficult. It may seem like it at the moment. And again, I'm just talking about the financial side of what's going on in Europe, Russia, Ukraine, because that's what the show's about. But obviously, there's even more important things going on, of course. And who knows how it's going to unfold? It could get worse. We don't know what's going to happen. But one thing I've said many times, and longtime listeners know this, is that when the stock market is down, what can make it scary is not the actual stock market per se, although probably not too many people like to see the value of their investments go down by a lot. But it's all of the fear and uncertainty that's going on in the world that caused the stock market to go down in the first place. I mean, sometimes it's just cyclical. You have, a lot of growth followed, things, the economy overheats. They have to raise interest rates. It slows the economy down. We have a recession, and there seem to be a lot of those cycles early in my time as an investor. That almost doesn't seem to be the most significant driver lately. So beyond that, then there are scary things that happen, and so it's not just that the market is down. I mean, if you think about it now, obviously, the war, with Russia and Ukraine and NATO countries, I guess to some extent, at least in terms of supplies. But you also have here, inflation is higher than it's been in many of your lifetimes, actually. I mean, you have to go back, 40 years? I remember those days, but inflation now is higher than it's been in 4 decades. And it appears to be getting worse, certainly gas prices. I was the other day, I filled up my wife's car, and her car takes premium, and I pull into a gas station, and I noticed the sign, there were no prices. I'm like, well, that's not a good sign. It's like, if you have to ask, you can't afford it. Well, so I pulled in, and I knew this gas station has, just, from living here for 30 years, it's one of the cheaper gas stations, always. So the gas cost $4.39 for premium. And I wonder what it is now. Anyway, so I'm there, I'm filling up. I'm going to look it up, because this was just last week, I don't know, Thursday maybe. While I'm filling up, and this was why the prices weren't on the sign, I see the guy with the long pole. It's got a suction cup at the end. He's hitting the numbers and putting them up. Wanted to hear him smack. Puts it up there. It went from I could think 39 is what I paid, but I guess got there right before it went to 4.59. It's going up 20 cents. I'm like, really? I wonder if I can find out what they're paying now. I'd have to go to the app. I don't want to do that. I'm sure it's gone up since then. So, we've got inflation. There's some talk that maybe we've got stagflation. And again, I remember that as well. I was a kid, high school, I guess, but you had high inflation and the economy was stagnant. It wasn't growing. It was like, terrible. And long lines at the gas station. Obviously, oil was a big issue. The whole situation in Iran in the late 70s, early 80s, kind of going into the Reagan administration. And of course, now the circumstances are a little bit different, but we've got oil now. I don't know it was up like $130. Price of a barrel of oil. What is it now? What's the spot? What are they? I don't even know. I guess it depends what you're buying. Well, it's only 120. So, I get all of the fear and uncertainty, but the reality is, at least so far in terms of the market, this isn't that exceptional. I mean, it probably feels like it for some of you, and I get that. But the reality is, particularly even if you're my age and you're gonna, let's just assume we all live to be 95, whatever. We'll probably experience drawdowns of 30, 40, or even 50%, 2, 3, 4 times, maybe, between now and, that'd be 40 years for me. If you just look at history, that's just kind of what happens. That's the bargain that we strike as investors. And I think that's true whether you invest in index funds, individual stocks, actively managed funds, maybe a combination of both. Now, I'll say, and I'll be curious to hear from you guys, and feel free to chime in. And I'm going to start going through the questions here. I've not sold anything. I bought a little bit of Berkshire, Wells Fargo, and Bank of America last week. They all fell, then they all went back up. Now they've all gone back down. But I haven't sold a thing. So no plans to. I'm having coffee. Speaking of coffee, I've got my cup. Believe it or not, it's coffee, even though it's 7 o'clock where I am. But I'm having coffee with a good friend tomorrow who just can't believe I haven't hedged. He thinks I should hedge. So I'll have to hear and figure out what he's doing. But he and I invest just very differently. So yeah, I don't think our investing careers are over. And I haven't sold anything. I haven't hedged. I haven't bought or sold any options. Yeah, this is what the market does. All right. So that's my I need to call this part of the live show something. It's my little 2 cents, worth every penny. All right, Jack, ACA subsidies, that's Affordable Care Act, and Roth conversions. IRR seems to go lower over time. Thinking this means the lump sum is being sweetened, but don't know. Well, Jack, I have to be honest, I have no idea what that means. I don't know what the question is. I do know that Roth conversions, of course, assuming you're converting something that was pre-tax, will generate taxable income. And depending on your circumstances, that could either disqualify you or lower the credits that you qualify for. Certainly true, one of many things that needs to be considered. But feel free to come back into the chat with maybe it's just I'm tired, I don't know. And I'm just not following. Could be me, probably is. Although, just as full disclosure, as I always do, I played a game of speed chess right before I went live, and I won. So I'm feeling pretty frosty. All right. Marv. Hey, Marv, welcome back. I think you've been in a lot of I'm trying to remember names, but yeah, I'm pretty sure you're a regular. And now I read his comment. I asked you this question last week. I guess that makes him a regular, but was called away. Upon reviewing the tape, I could not locate the response. And then I don't see the question. I don't know what the question is, Marv. Maybe I'll come to it. Maybe a lot of questions got in the way. We'll see. All right. Arun says, please explain how to reinvest dividends with minimum impact on taxes. Well, okay, we're talking about a taxable account, right? Obviously, since you want to talk about taxes, and in an IRA or 401k, there's wouldn't be an issue. So when the dividends are paid, that is income that's subject to tax, right? What tax you'll pay depends on a lot of factors, of course. And it could be zero, actually, if you're in a 0% capital gains bracket, assuming they're qualified dividends. But in any event, the reinvesting of them, whether you do that, have it set up so that it's done automatically, right, which you can do, or you do it, on your own, where it goes first to a cash account, and then you decide where you want to reinvest it, because you don't have to reinvest it back into the investment that paid the dividend in the first place, right? There's no rule, there's no dividend police that says, wait, Bank of America paid you that dividend. You can't take that money and invest in Wells Fargo or VTI and invest it in VXUS, right? But the actual reinvestment itself isn't a taxable event, right? So yeah, I hope that helps and if I've missed something, let me know. But yeah. All right, Caleb, looking forward to the stream. Thoughts on equal weighted indexes versus market cap? I don't like them, I'll tell you why. Especially considering your comments in previous videos saying that we may be swinging back to value. So just so we're on the same page, at most, I think it would be most, all the index funds virtually that we talk about are cap weighted, meaning take the S&P 500. Let's assume there's 500 companies. It's often not exactly 500, but in a fund. But in any event, take S&P Vanguard's VOO. If you were to invest $500, Vanguard doesn't pass out $1 to each company in the S&P 500. They put in an amount equal to a percentage that's equal to the value of that company divided by the total value of the S&P 500, and value meaning the market value. So I assume Apple is still the number one, right? I don't know, actually. Is it going to be Apple or Microsoft? In any event, they're going to have a lot more of that $500 going to companies like Microsoft and Apple and Tesla and and Berkshire, the big companies. And the companies that are 490 on the list or 495 get a couple of pennies. I mean, it's small. And when I first learned that, I don't know when, a long time ago, I thought that didn't seem right. I thought this was supposed to be passive, but it's like they're picking and choosing. But if you think about it, but passive in this sense means let's mirror how the market allocates capital. And the market allocates more capital to Apple than to a small company. So in that sense, I think it makes sense. Equal weighted would say, no, we're going to pass out $1, of your 500 to each of the 500 companies. And so the reason I'm not a fan of equal weighted is so if you think about equal weighted, let me pull one up. Let me see if I can find an equal weighted. I don't know any off the top of my head, but we can find one. I'm sure many of you do. Well, let's see. Okay, we'll just use Invesco. So I'm gonna pull this up. What's the ticker? RSP? Yeah. Let's go to Morningstar. I'll pull this up on the screen. And we're going to go to RSP. So this is a equal weighted, the Invesco S&P 500 equal weighted. And if we go to the portfolio and we look at the top 10 companies, right, you can see they don't actually literally, the weights do vary a little bit. And you think about that, as soon as you were to equally distribute the capital, then market prices change and different things, but they're more or less, as you can see, more or less the same. And many of these companies, I mean, this doesn't look at all like, if we go to VU, for example, go back to Vanguard, and we look at the top 10 companies. Got to go to portfolio. Here we go. Scroll down. And here we go. Yeah, Apple, Microsoft, Amazon. So if we were to look at, well, the other thing I want to show you before we go, I'm going to show you Portfolio Visualizer, but this is sort of your typical S&P 500. The blue dot, which represents this fund, can move back a little bit. It's a little tilted towards growth, but it's usually a blend, which is what BLD stands for, and it's a large cap, right? But if we go back to RSP and look at it, go to portfolio. See, it's in this case it's value, which is the Caleb's point, I think, among others, and it's it's still large companies, but not. I mean, it's more like a mid/large, right? So that's sort of the difference, right? Now, I have no idea which ones have performed better. I would Well, lately the S&P 500 would have, but I don't know long term. Let's see how much data we can get. We'll do VU. And what was it? RSP, right? Yep. And then I'll tell you why I'm not a fan of RSP or of equal weighted. So this gets us 11 years or so, roughly. And yeah, it's actually not as different as I thought, but it doesn't surprise me that the S&P 500 has done, because the big companies just done so well. I imagine there are going to be periods of time when the reverse is true, right? And if we look at annually, well, there are some years that equal weight won out. Even recently, 21 was a little higher. That's interesting. And this year, it's winning in the sense that it hasn't lost as much. So there you go. But to answer the question now is I love the idea of investing in smaller companies, which in effect is what an equal weighted index does in this case. Get you more pushes some of your capital into smaller companies, mid-cap companies. I would just prefer to do that myself if that's what I want to do. So you could just do VTI, right, a total market, or if that's not enough, you even want more exposure, then do an S&P 500 and a small cap, maybe even a mid cap. Again, we're complicating the portfolio, right? We're now, if we did large, mid, and small, we've got 3 funds, as opposed to say 1, but still not the end of the world if this is important to you. And if you're a value investor, and I sort of put myself in that category, you can get a small cap value and you can control, by your allocation, exactly what you want. Now, I suppose some would say, well, isn't an equal weighted index sort of a simple way to do, Rob, what you've just described? And I suppose if it turns out that it has sort of the kind of allocation you want, then I suppose so. Yeah. But for me, it would be underweighted some of the larger companies. I personally wouldn't be happy with that, the smaller exposure to the big companies. So that's just me. There you go. All right. Kyle has maybe the question of the year. He says he's reading a financial planning book, and the author mentioned he had a bunch of unpaid parking tickets in his car. Why would you let these go unpaid? The guy's probably an idiot. For those of you who have not read my book, Retire Before Mom and Dad, and you think I would have it displayed back here. By the way, I don't know why I have my chess magazines displayed like that at the moment, although they are colorful. He's referring to my book, Retire Before Mom and Dad. When I was in law school, we lived on Beacon Street in Boston, right by Fenway, and we couldn't afford parking. A parking spot at our little brownstone, which, by the way, if that sounds sort of romantic and neat and wow, no, it was a slum, literally. I mean, it violated numerous housing laws. I can tell you that right now, and it was owned by Boston University. Should have sued them. Anyway. We couldn't afford a parking spot, which I think was $70 a month. Now, this is like 1989, and we had no money. So I would sometimes drive around for literally an hour looking for a parking spot. And yeah, over time, I may have acquired a few parking tickets. And one day, my wife and I go to the car to go somewhere, and she opens the glove box, and all of these parking tickets fall out. I don't know. That was not a fun day. I can tell you that. I think I've tried to make it up to her since then. Her car did get stolen at one point and recovered. Anyway, all right. Travis wants to know about the pros and cons of investing in real estate versus the market in downturns such as this. If you had the capital, why would you choose one over the other? Well, first of all, I'm going to assume by real estate, you don't mean a REIT, you mean actually owning rental property. And I've owned rental property. A friend of mine and I ended up buying a total of 5 HUD foreclosures beginning in 2005 through 2008. And I just sold the last one, a couple of years ago. And the first thing I would say, people like to compare them, but they're really not, in many ways, they're not comparable, because buying real estate, you're a business. You're now a business owner. You're not a passive investor. And that's true even if you hire people to help you. This is an active business. Now, I think there could be a lot of advantages to that. I mean, a lot of tax advantages to investing in real estate. I think You can use leverage to some extent as long as you're careful. And that can help returns. But again, people get overextended, and that's like the worst position to be in. And one thing goes wrong, and your whole real estate business can go down. I mean, that's sort of Dave Ramsey's story, right? He did things in real estate that I wouldn't have the nerve to do. I mean, or at least he did at one point. At least that's my understanding of his story. So you've got to be really careful. But I think real estate can be a great way to build wealth, actually. And I don't really see it as stocks versus real estate. I see a place for both. I've thought even now about investing in real estate. Honestly, what's kept me from doing it is just the headaches involved. Again, and that's true. Even if I hire someone, I hire a company to manage it, which of course is expensive. I'm still on the hook. I mean, I would have protections from liability in a number of different ways. But I mean, it's still my investment. I've got to manage it, even if it's indirectly. And right now, I just don't want the headache. But I will say, I don't think it's quite fair to look at, say, the current market and say, boy, wouldn't real estate be a great investment because I don't have to deal with this? Because real estate can get ugly too. And in recessions, you may have a hard time renting your place. It can go unrented, unleased for several months and put a real damper on the old cash flow. And that's not even counting, the late night phone calls. Again, you can hire people to deal with that, but then there goes a fair part of your profit. So I think it's a great way to build wealth. It's just, it's work. It's a lot of work. The one thing I did with my sister, who's a painting contractor now, has a great business in Central Ohio. We flipped a property, where you buy it, rehab it. After doing that once, I would never do it again. Again, some people make a killing, do great. But it's not great from a tax perspective. Assuming you turn it around in a year, you're getting hit with short-term capital gains. Yeah, I won't do that again. I mean, it worked out fine. I think we made a profit. I don't remember how much. It was a while ago. All right, VJ. He sounds familiar. Hello and happy Monday, Rob and team. By the way, just so you know, there's no team, VJ. It's just me. From Ann Arbor. He's from Ann Arbor. Will Michigan be in the tournament? And by tournament, VJ, I mean the big show. There's that other tournament. I forget how it goes. Is Michigan, I don't know. Michigan basketball. I'm sure they should, right? They've probably beat Ohio State for all I know. They're 8th in the Big Ten. Wait a minute, that 8th? Well, the good news, VJ, is I think there are more than 10 schools in the Big Ten. So you got that going for you. But before I get all cocky, I should see, what's Ohio State? Michigan beat Ohio State yesterday? Oh, that's not good. That's not good. 75-69. I apologize, VJ, for saying bad things about Michigan basketball. What are we? Well, we're 5th in the Big Ten, though. So, I mean, I don't want to, all right, enough of that. What's your question? Let's see. VISVX versus FISVX. Okay. Fidelity Fund has AMC as the top holding. And Fidelity IRA, is it still better to pay transactions fees and go with VISVX? I have no idea, but let's figure it out. Honestly, I don't know what these funds are. Or if I did, I forget. Let's see. Okay, well, that's just a Vanguard small cap value. That's VISVX. VISVX. I'll show you these on the screen in a minute. Can't believe Michigan beat Ohio State. Must have been the officiating. It's the only thing I can think about. FISVX. Honestly, I'm not really, I'll root for Ohio State. I don't really watch a lot of college, but I'm not even a March Madness. I don't know. It just doesn't. All right, Fidelity small cap value. All right, so here they are. Fidelity's is 5 basis points. Vanguard is 19, so it's more expensive. But I think what's got VJ concerned, if I'm following his question, and I am from Ohio, so I'm a little slow, is that he doesn't like the fact that AMC is a big position in Are we in Fidelity? Fidelity. Let's see if I've got that right. Oh, well, it is, although it's less than 1%. Right? And this is value, right? That's interesting. I wonder how they define value. In any event, if we go to Vanguard's portfolio, AMC is not in the top 10. Let's see if if we can find it at all. See, AMC, why is AMC listed as a value stock for Fidelity? That doesn't make any sense to me. Although I haven't looked at the stock, maybe it is a value stock, but isn't it? I can't imagine. Look at this, it's not in here at all. So let's real quick, let me pull up AMC. Let's take a look at AMC. I love the movies. That's what we did as kids. That's, it's all I could afford. We had a theater, it was $1 to get in. Bucket of corn, nothing better. This is value. That's interesting. So they're saying that according to a Morningstar, it's right here. We can go to the portfolio. Maybe. Oh no, this is thinking this is a fund. They're calling this a value. We can go to valuation though, and well, as I say, what's its PE? But I would have to have a profit to have a PE. So they must be looking at other factors, but I don't know what. So anyway, well, I don't know. I don't know personally, VJ. I would not make the decision based on the fact that AMC is in Fidelity's fund, and apparently it's either not in the Vanguard fund or in such a small amount it doesn't show up in the top 100 companies. I would, I'm kind of surprised that Vanguard's fund is so expensive. But I wanted to look at performance here. I could put it in Portfolio Visualizer, I suppose. There aren't that many years. So Fidelity, it's lost 5% this year so far, and it's done a little better. Vanguard's done a little better. Last year, Vanguard almost 28%. This was just over. In 2020, 4.48. This beat it. I mean, it's a toss-up, frankly. I mean, we could look at other things. For example, we could look at just how small the small cap and how much value, and you might make a decision based on that. So here's Vanguard's, and here's Fidelity's is much smaller. But again, it's hard to look at we can look at the differences here. Price to earnings, PE is 1183 for Vanguard, 1220. I mean, these are very, very similar. It's going to be a toss-up which one does better from year to year, VJ, honestly. I would probably, all things being equal, I'd probably go with the less expensive one, because I wouldn't think that I have a good basis to distinguish between the two for other reasons. But honestly, and there's not been much history, but it's kind of hard to, I mean, there's going to be years when one outperforms the other. They're very close. David, is there any downside to iShares versus Vanguard ETFs? Well, we'd have to look at specific funds, but iShares are great. I've never owned any, but like if we look at, let me see what I can pull up here. So I'm just looking at the iShares S&P 500. It's 22 basis points actually. That's a mutual fund. Hang on, let me pull it up here. You do have an ETF, right? Oh yeah, IVV, of course. So here it is. It's got to be cheaper than. Yeah, it's just 3 basis points. And this is going to be a perfectly good fund. I mean, I know we're just looking at one fund, but I mean, iShares has good low-cost funds. We can put it in here. I don't know how much data we have. They should be, so we've got the same amount of data. They should be, I would think, similar. Yeah, look at that, almost. Well, Vanguard beat it by $3 over an 11-year period. So yeah, again, that's just one fund. If you have specifics you'd like me to look at, but I think iShares are good. So Bob says, and by the way, I think I forgot to mention, but if you want me to cover a question or topic, tag me in your comment. But I see, Bob, your question. Things are getting scary with me in, I guess it looks like you've got 80% into the market, I guess. Throw it all in or dollar cost average the rest of the way. And if the latter, how often? See, that's just it. I think the most important answer to that question that I think an investor needs to realize is there's no way to know. It's impossible to know which one will turn out better. And if you're dollar cost averaging over, you've got some money, you're dollar cost averaging over a relatively short period of time, 6 months, a year, and you're a long-term investor, it's probably not going to matter much. I mean, we could certainly imagine a scenario where the market tanks by 50% and then goes back up, or goes up by 50% and goes back down. But by and large, it's just not going to matter a lot, in my view. Now, it might matter emotionally. You put it all in, tomorrow, and the market goes down another 40% this year. You're going to wish you dollar cost average, but there's just no way to know. And people think they know, even now. So let's make a guess. What will the S&P find? It's down 9.5%. Where will it be by the end of the year? How about this? Will it be positive or negative? I have no idea. I mean, I can come up with reasons why it might be one or the other, but the truth is we don't know. There's no way to know. So Doc wants to know, is an investment strategy different in a retirement account versus a taxable account now that we're in a bear market? So it's kind of almost two issues. The first question is, when are you going to need the money? And if the answer is the same for both, that's question one. I mean, if you've got a taxable account and you say, well, I'm going to spend that money in the next 10 years, but my retirement account, I'm not going to even start spending it for 30, and then I'll spend it slowly. So, I mean, that's the first question. What are you using the money for? But let's just assume it's all for retirement. You're just, you've maxed out some retirement accounts and you're also saving in a taxable account. Okay. We'll assume that. Then for me, this is my approach. My only difference is from an asset location perspective. And I think of that in 3 buckets: taxable, sort of a traditional pre-tax retirement account, and then Roth. And I would throw in HSAs in there as well, because we use ours for retirement savings. And so I want stock, in our case, stock index funds in the Roth, because I wanted to get as fat as a tick. I want as much of my bonds as I can in traditional pre-tax. They're an important part of the portfolio, but I just assume not have, if there's going to be asset classes with lower expected returns, I would just as soon have them in traditional retirement accounts, because that will keep down my RMDs. Kind of seems odd saying that. It's like, yeah, I really don't want my investments to grow in that traditional account, but I think you get the idea. In many cases, and this is true for us, we still have stock index funds in our traditional accounts. They're not 100% bonds. I'm coming up with my asset allocation first, and then trying to fit it into the accounts that I have. And then and so if I'm going to have REITs, I'm going to have those. It could be in a traditional or a Roth, but not in a taxable account. And then the taxable account, I want, again, within reason, stay as tax efficient as I can. So for me, that's generally stock index funds. I have individual stocks. If I have a bond fund, which I do, it's not always a municipal bond fund, that has some tax advantages, but often it is. So that's the way I think through it, Doc. Doc Marty, I like it. DB Douglas says, your YouTube content is appreciated. Well, thank you. Alex, by the way, and I would appreciate your comments to this, even if I don't get to them in the live stream, I'll read them later. What I'm thinking of doing next week, and I've got a link below, is spend the hour and a half using New Retirement. So New Retirement is a tool that helps you plan for retirement. It's particularly useful once you're in retirement, but it's great for planning. I've shown it to you guys before. I'll show it to you just briefly. This is a demo account. So, but kind of spend the hour and a half walking through this tool, not just to show you this, but also to talk about the issues that come up. I mean, this, we could be talking about long-term care insurance questions, Roth conversions, expected returns, inflation assumptions. I mean, there's all kinds of stuff that goes into this tool. And I'm thinking about just spending the time walking through it with you guys. If you guys have this or use it, you can walk through it with me. I've got a link below. So New Retirement is a partner of mine, an advertiser. They have nothing to do with next week, by the way. They don't even know I'm doing it, and they won't be a part of it. So we can say good, bad, and otherwise about New Retirement. But by the way, I also, and this was something that came up recently. If I have a tool like this and they're an advertiser, I pay for it. I don't get this for free. The demo account, they have a free version, which is what the demo account is, I think. But my personal account with them, I pay for it. In any event, that's what I'm thinking of doing next week. I don't know. And then maybe weeks later doing other tools, or trying to focus the discussion around maybe a topic or a book, maybe. I don't know. It's a thought. Let me know what you think. Tamara, hello from Denver. Love Denver. Do you have any insight, not usually, as to why BND has been performing poorly? Oh, now that I do. Down 6.5% since October 2020. So it's a great question. Let's take a look at BND. First of all, we'll pull it up in Morningstar. It's a Vanguard Total Bond Fund. Do I own this? I should know. I don't know. I don't own the ETF version. I know that. Anyway, doesn't matter. So if we look at performance, we can see for the year, it's down 3.1%. And last year it was down 1.86%. So why is it down? And is it normal? And so the reason it's down, so bond funds make money in two ways, right? The interest on the bonds, right? So that's sort of probably how we think about bond funds and bonds making money generally. But also the value of the bond itself can go up and down. So these bonds are can be traded, and they're bought and sold. And in the case of investment grade bonds, U.S. government bonds, the price is generally determined primarily on the interest rates. So as interest rates go up, the value of the bonds go down. And again, just to sort of walk through why that is, let's imagine you buy a U.S. government bond that's paying 2%. And we'll call it a 10-year bond. And rates for new 10-year bonds a month later go up to 3%, and you decide to sell your bond. You need the money. So you say, I got a $10,000 bond. It pays 2% a year for 10 years, and you get your 10 grand back. I'll take 10 grand for it, face value. I'm not looking to make any money, just 10 grand. And the buyer says, well, we'll slow down there. I can go get a new one, and it pays 3%. So why would I give you 10 grand for your bond that only pays 2%? And yeah, that's a pretty good point. So what you have to do is discount below 10,000, below the face value. Normally it's $1,000 face value, but whatever. Below, in this case, 10 grand, so that the net effect for this buyer is they'll get 3%, right? They'll get 2% that the government's going to pay them on the bond, right? And then by getting the bond at a discount, that makes up the other percent. And it's just all math to calculate that out. Don't ask me to do the math. I was an English major. But in any event, that's the concept. And the reverse is true. If you have your 2% bond and rates fall to 1%, well, then you're looking pretty good. It's like, hey, who wants to bet on my bond? You get 2% instead of 1%. Of course, you can't get too excited about it because they're only going to pay you a premium such that the yield they get is whatever the prevailing yield is in this hypothetical 1%. So having said all of that, interest rates have gone up. Right now, they've come back down. Let's take a look. So this bond fund, let me just show you this. This bond fund is an intermediate term duration. And what that means is you could kind of think of it as a weighted average time when the bonds that this fund holds will mature. That's kind of a general, it's close enough definition of duration for our purposes. And what this means is generally, if interest rates go up by 1%, the value of this bond fund will go down by about 6.8%. And if interest rates go down by 1%, it'll go up in value, right? So if we think about the 10-year, this isn't a perfect match for that fund, but it'll give us an idea. I'm going to pull up the 10-year, see if we can find it. Here we go. Let me make this a little bigger. That doesn't help. Well, that's as big as it gets. So it's currently 1.76%. It did go up. You can see, you mentioned October. So it depends when in October, I guess. But you can see the interest rates started to go up. They came down a bit, came down some more, but then they started to decline. Boop, 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 boop. And so that sends the value of the bond fund down. Now, since then, they've come down a little bit. So if we looked at daily prices, the bond fund has probably gained a little bit, but that is why the value of the fund has come down. And generally speaking, if we think long-term, we forget all the craziness that's going on in the world at the moment, many things. I started to say even Michigan beating Ohio State in basketball, but then I thought, yeah, maybe that's not the right time to make a joke. And then I said it anyway. Anyway, if you put all the craziness in the world aside for just a moment, and we think longer term, boy, the interest rates are at historic lows. Inflation is, at historic highs, not the highest, but certainly over the last generation, right? 40 years. We can kind of think that interest rates will probably go up generally for some period of time. They'll have times when it falls, but generally we would think, if we were guessing, that the trend will be upward. And so we could see bonds as, losing some money. Now, even as they're losing value because interest rates go up, you're still getting the interest payments, right? And as they sell bonds at a loss, but then buy new bonds, those new bonds have higher yields, right? Because interest rates have gone up. So over time, you'll make your money back. But yeah, bond funds can lose money. And that was probably, is anyone even still watching? A few people. You're probably like, you guys have all left. I'm just talking to myself about bonds. My wife strolls down. It's like 1 a.m. Rob, what are you doing? I'm explaining bonds, honey. All right. Okay. Jeffrey, what do you think of buying VTIP, speaking of bonds, in a retirement account as an inflation response? I think it's great. I'll show you VTIP. It's interesting. I have on my screen how many people are watching right now. And it's pretty good. It's pretty strong. And why is that? And it's because, I think, if I had to guess, well, VJ's here every week. So are many of you, and I appreciate that. But yeah, the market is down. People are scared. We're in the middle of, not the US, but the world is in a, pretty significant, I guess it's a war, right? And yeah, people are nervous. I get it. I still haven't sold anything, so I don't know. I don't know what that'll do for you, but I do try to live the same way I talk at least when it comes to investing. I can't say anything else about my life. Who knows? All right, enough chit chat. Here's VTIP. It's a short-term inflation-protected security. I have intermediate term tips, so this one's, but still, tips. Yeah, tips are longer term in terms of bonds, a way to protect against inflation. Now, the way tips work, if you think about a tip, so depending on how the duration of the fund, you can imagine, and these are U.S. government bonds, right? So you can imagine inflation-protected government bonds with a maturity, we'll just say 2 years. And then regular old treasuries that aren't inflation-protected. right, for 2 years. Well, what would those look like if we compared them to one another? I mean, obviously the TIP has some kind of inflation protection. We'll talk about how they do that in a second. And a regular old treasury doesn't. And so which one do you think would pay a higher interest rate? Well, with the TIP, the government's got to effectively protect us, give us an insurance policy, if you will, against inflation. Well, that costs something. What's it cost? Well, lower yields, right? So, and it's often viewed as, when you're comparing TIPS and treasuries of the same maturity, the difference in that yield is the market's guesstimate of what inflation will look like over the term of those bonds. I'm sure if you're a bond trader, you would say, Rob, you're missing a lot of nuances, and I'm sure I am, but generally I think that's correct. So it turns out that, well, what if the market's wrong? Let's just say the spread is 1.5%. I'm gonna make something up, 1.5%. Well, there's no guarantee that's what inflation is going to be over that period of time. And I would go even further. No, the market is absolutely wrong. There's no question it's wrong. It's always wrong. And it constantly adjusts because it's wrong. Right? And I'm putting wrong in quotes. So the question is, well, okay, but which one is better? How do TIPS protect against inflation? So the interest rate that the government will pay on a TIP, never changes. Once they sell the bond, let's say it's paying 1/8 of a percent. I'm making that up, but that may not be too far from the truth. And it's a 30-year bond. That's what it's going to pay. That's never going to change. So it's like, okay, remember, I-bonds, there's a part of the interest rate that does changes every 6 months. But with TIPS, the interest rate doesn't change. It's locked in. So how does it protect us against inflation? Well, the principal balance, the face value of the bond itself changes. So if you put in $1,000, you're always going to get whatever the interest rate is, but that $1,000 is going to get adjusted up when there's inflation measured by CPI, and it's going to go down if there's deflation. Not that we have to worry about that right now. And the interest rate gets applied to that changed balance. And so over time, if there's a lot of inflation, the balance goes up and up and up and up and up. And then when the bond matures, you get whatever that increased balance is. So it raises the question, well, all right, it's like, all right, Rob, it's late, I'm trying to get the kids to bed, what, so what? Or what do we do now? Well, that's the point, is we don't know which one's going to prove to be better, because we don't know it all depends on what inflation is going to be. And we don't know. We can all guess. I'm sure we all have opinions, but we don't know. So one approach, and this was, again, I've mentioned this in the past, David Swenson, who ran the Yale Endowment, passed away, unfortunately, a little while ago, but wrote some good books. Unconventional Success is one of them, I think. It was the title. What he said was, look, if inflation turns out to be higher than that spread that the market thinks, if it turned out to be higher than that, TIPS went out. Because you paid for insurance and you needed it because inflation really took off. And if the inflation turns out to be lower, well, then you accepted this lower yield for TIP, and inflation turned out to be no big deal. You'd have been better off with the Treasury. So his approach was to split your bond portfolio between TIPS and nominal bonds. It doesn't have to be Treasuries. Could also be investment grade corporate bonds and so forth. And that's generally what I do. If you look at my portfolio today, at the moment, it's not an actual 50-50 split right down the middle. But in concept, I think that just kind of resonates with me. That makes sense. Jeffrey, that's probably more than you bargained for, but there you go. Roger, so many questions, so few answers. The questions are the important part. The answers, I do my best to give you my opinion, but it's really asking the right questions. That's step one. David, welcome from Salem, Oregon. All right. Alex, how do you compare FTEC to VUG, Vanguard Growth Fund, and QQQ for tilting 10% to large cap growth? Now that it's down 19% year to date, which one would you pick? This is not financial advice. No, none of this is financial advice. I'm not a financial advisor. Well, I wouldn't tilt my portfolio to growth. I never have. But if I were to do that, let's take a look. We got the Fidelity. I'll show these on the screen here in a minute. Let me pull them up first. got VUG. We know that one. And then QQQ, that's NASDAQ, right? So if I were going to tilt towards growth, I would not go with QQQ. It's too focused for me. It's not just, I'll show you. It's not really, well, I say that. Let me make sure I'm right about this. Here's my concern with QQQ. And I know, by the way, it's done incredibly well. Not here very recently, but it's done incredibly well. My concern with it, at least, yeah, so it's 50% tech, which kind of makes sense. If you go to Vanguard Growth, I got to believe Vanguard Growth is not 50% tech. But I could be wrong. Well, it's 42. Yeah. And maybe that's just the way it is with growth. I get it, because so many tech companies are high growth investments. Well, this is obviously going to be tech. So of these three, this one's 91. I definitely wouldn't do this one. My point is, if I don't see a reason to tilt so much to tech itself. If I'm going to tilt towards growth, I'd rather tilt towards growth, as it's almost regardless of the sector, right? If I want to make a sector play, that's one thing. But if I'm trying to tilt for growth, which is what I understand your question to be, of these three, I would probably go with Vanguard, the Vanguard fund, for that reason. Now, whether it's going to outperform the other two over pick your period of time, I don't know. I'm just a guy in a basement with some goofy chess magazines behind him. Although, in fairness, I did win the Blitz game that I played before. I played someone from Poland. When you play on chess.com, you have your little flag. And he was from, or she was from Poland. Greg wants to know, will I be doing a video on 457B plans? Well, I hadn't planned on it, but if you have a specific question, I've never had a 457B. But if you have a question, I'm happy to entertain it. Anyway, it's for like state and local governments, right? Yes. I've never worked for a state or local government. I've often been upset with their services, particularly at the DMV. Okay. Rap Freak, welcome back. Oh, he used to shop, or I say he, Rap Freak, used to shop at Westland Mall. Okay, Rap Freak, do you remember when it wasn't a covered mall? It was an outdoor mall. Do you remember that? If you do, you probably have either no hair or gray hair like I do. So thoughts on performing Roth conversions now with the current dip. So the idea there is, let's say you're going to convert, pick a number, 50 grand. You'd much rather, you'd prefer to convert when prices are lower. If you think about it in terms of number of shares, you're going to be able to convert more shares of whatever fund. I mean, yeah, you might sell it to cash and convert it. How you convert it doesn't matter really. Well, it matters, but in any event, yeah, you'd prefer to convert when prices are down, because you'll be able to convert more shares for the same dollar, right? However, you still obviously have to figure out whether conversion makes sense for you or not, and that's a different issue. But you used to be able to recharacterize it. You can't do that anymore. And the reality is, timing it, I think, is like any market timing, is a crapshoot. I mean, you could say, well, let's do it now, but you're saying that because, we can just look back not that long ago and the market was higher. Now it's lower, so let's convert. Well, okay, it might go lower further, right? I mean, you may convert now and it drops another 20%. So, to me, does it make sense to convert? And it's not just a market issue, right? All the other factors that go into Roth conversions. Does it make sense or not? If it does, I would convert. If it doesn't, I wouldn't convert. Yeah. Stephen O'Brien, I am so excited. Just home and heard the good news about the markets heading in the right direction for some opportunistic Roth conversions. Well, Steve's all in. It's literally the next comment. Maybe it was actually as a result of the previous comment. All right. I'm not converting yet this year. I kind of regret that I didn't convert some last year. That was a mistake. but I was really trying to evaluate my conversion strategy, and I think I've more or less figured it out. It gets complicated. I'll give you an example. And this is just one of many complications. We give money to charity. Right now, we donate appreciated stock to a donor-advised fund. But once we get to RMD age, we could do qualified charitable distributions out of the IRA. Each of our IRAs up to a big number. It's up to 100 grand, which I think that might actually not be indexed for inflation. But in any event, if you're going to do that, and it doesn't have to be 100 grand, maybe it's a much smaller amount, but that will affect whether a Roth conversion makes sense. I mean, there's just a lot to think about. So Jared wants to know my thoughts on risk parity style portfolios, gold and long-term treasuries, both up in a flight to safety today. I'm not a huge fan of risk parity. I know that you can look over periods of time when they've done well. So folks, if for those that don't know what risk parity is, I'll describe it for you again. Those that have studied risk parity for a very long time may not like how I describe it, but I'll do my best. Imagine that you think of investments that can do well in any market. So and sometimes they think of it in quadrants. So you might have, like he mentioned, like Jared mentioned, gold and long-term bonds, which behave in certain ways in different markets and different interest rate environments. You might have an S&P 500 or some stock exposure, but you have these different asset classes to kind of represent different economic cycles. For example, right? Are we growing? Are we in recession? Is inflation high? Is inflation low? Ray Dalio would be big into this sort of thinking. And then the problem, though, not a problem, but the reality is, if you come up with a portfolio like that, you might not have very much in stocks, right? And so if you think about the expected returns and the risk of that portfolio, particularly if it's heavy in bonds, you might have 50% in long-term bonds. Your expected returns are not very high, and your risk as measured by volatility is much lower than, say, an 80-20 portfolio. But what a risk parity would say is, that's okay. What we want to do is we want to get these assets that, we want to put them in to the portfolio in a percentage so that they each represent a roughly equal level of volatility. So you think about it, bonds, you'd have a lot more in bonds because their volatility is lower. So you need more for to do the math so that the volatility of that larger bond allocation equals a smaller stock allocation, which doesn't have as much in the portfolio, but it's higher volatility. And so their volatilities match. The risk is, as measured by volatility, is similar. When you do that, again, though, your expected returns are a lot lower. So what do? You add leverage. And that's how you get the risk, as defined by volatility, of this risk parity portfolio back up to the equivalent of, let's say, an 80-20. I hope that made sense, although as I said it, I'm thinking, it probably didn't. But that's basically what's going on. And to me, it's just a lot of headache. Now, you can probably find a fund that does it. I don't know of one off the top of my head. It can be expensive. Leverage can be expensive. It's just, I just don't. To me, it's a solution in search of a problem. All right. So, Conscious, do you plan to increase your international emerging market allocation? I don't think so. It's 15% developed, 10% emerging. I don't see any reason to change it. Oh, Matt wants to know if I'd ever do a video on the equipment setup used to film the stream. I'd be happy to. I can actually leave you. Let me see if you bear with me. I have an Amazon list that lists a lot of what I have in my setup. How do I share this? Send list to others. View only. Copy link. Let me see if it works. Paste. enter. There it is. I'm going to actually do this. All right. Make sure, just double check that it works. There it is. All right, good. I'll put it in the chat here, but I'm happy to walk through it. There you go. All right. This person's name is Rob Burger Fan. You poor soul, you. I have a large amount. This is Rob Burger Fan, not Rob Burger. I have a large amount of, by the way, so there's a Facebook page now that's pretending to be me. In the chat, in the comments to videos, there's constantly people trying to pretend to be me with WhatsApp numbers. And trust me, I'm never going to ask you to call me. I love you all. Never, ever going to ask you to call me. I have a large amount of 401k and doing Roth conversions over 6 years to take advantage of historically low tax rates. The Tax Cuts and Jobs Act of 2017 expires in 2025. Medicare for surcharge determination looks back 2 years, that's true, at federal tax returns. When they look back, do they use the current IRMA bracket or do they use the one published 2 years earlier? So I am reasonably confident they use the current one. But I wouldn't swear to it, but I'm pretty sure they use the current one. At least that's what makes sense to me. Believe it or not, I'm not old enough to be on Medicare. I know it's shocking to some people. They're like, really? I thought you were actually too old to be on Medicare. I don't think that's possible. Yeah. So Nath says, I am yet to invest in REITs and currently seeing only one fund in my HSA, VGNSX. Can you please review and provide your insights? Well, yeah, I've invested in VGNSX. At least if it's the fund I think it is. I wonder if the ticker's wrong, or did I just type it wrong? I thought it was the Vanguard fund. Let's try Vanguard REIT. Oh, Morningstar is not behaving. All right, there's another way to do this. Well, it's VGSLX. Yeah, maybe the N should have been an L. So here it is. This is the fund on Morningstar. 12 bips for expense ratio, very inexpensive. There's an ETF version if you prefer that. VNQ, I think. Yeah. I think this is a good fund. Low cost exposure to REITs. And I've owned this fund. I've owned the mutual fund version for a long time. I'm not sure how long, but a long time. And I don't know what else to say about it. It's pretty basic, REIT fund. You can check out the portfolio. I'm looking at what some of the top holdings are. Realty Income. That's a well-known REIT. Public Storage. American Tower. A lot of folks were worried, with COVID, like all these malls closing down. But I don't know the percentage, but my hunch is there's relatively little here in terms of that kind of thing. Although I say that and think, well, I shouldn't say that because I don't know for certain. But REITs hold a lot of things like American Tower, right? Storage companies. Realty Income owns a lot of real estate, like for a Walgreens, that kind of thing. But yeah, I'm happy with the fund for what it's worth. All right. Usha, if I'm pronouncing that right, likes my 2 cents. That's what we'll call the opening segment of the show. That's my 2 cents and worth every penny. Clarice. I was just lamenting the fact that the show Clarice was canceled after 1 year. It's a travesty. Clarice says, I have a 3-fund portfolio. My Roth is made up entirely of VXUS. Is it better to move to 50% VXUS, 50% VTI in my Roth? Or better to switch to VTI and Roth and hold VXUS and other accounts? Well, again, we want our Roth to get as fat as a tick, at least in most cases. Maybe there's an exception to that, but I can't think of one. And so then we get into this whole question, well, over your investing time period, which one's going to do better? Well, if we look at history, we'd probably put VTI in there, right? Although some could say, yeah, but given valuations, maybe it's VXUS, which is an international fund for those not familiar. Maybe it's international funds time. If you wanted to just play it sort of safe and say, look, I'm not going to bet one way or another. I'm just going to put 50-50 of whatever your allocation is, but into the Roth. That seems reasonable to me. I personally wouldn't put all international in my Roths. If I'm going to do one or the other, probably would do U.S. stocks. But of course, there's no guarantee that they'll outperform. So kind of putting a little bit of both in seems reasonable to me, just understanding that we're making the best guess we can, right? I mean, that's what we're doing, as long as we understand that. Jim wants to know where the Red Sox banner went. Well, it's not a Red Sox banner. Oh, here it is. I can see the glare. See, that's why I don't have it up, the glare. But yeah, I worked at the Public Company Accounting Oversight Board. So if there are any public auditors in the house, I was in the enforcement division. I was the person you never, ever wanted to hear about or hear from. I remember when I started working there, I emailed the head of a very large accounting firm a document request. And I just started, and I'm not sure how they're going to. I got a phone call in like 10 minutes. Yeah, that's what that is. Not a Red Sox banner. Although I'm kind of a Red Sox fan. I couldn't name a single player on the team. But, we lived in Boston for 3 years, went to a game. I don't know if they revamped the stadium. I got to tell you, the bathrooms were atrocious. I wouldn't. Whoo! Okay. I don't know where that came from. Jock Doc, who I think was here last time. 69 years old, working and have inherited an IRA and a traditional IRA, totaling 2.5 mil. Should I still fund an IRA or begin Roth with my earnings? Irma, RMD's looming, other options, any books you recommend? Well, I do have a book. I'm looking around to see if I can find it, but I think it's actually on my iPad. It's a Kindle book for me. So let me pull it up on the screen. Oops, I mistyped Amazon. All right, let's see here. It's Retirement Planning Guidebook. Yeah, here it is. So this is by Wade Pfau, who does a lot of good work on retirement, written a couple of books. But this is pretty comprehensive. This is not, this is, he goes into a lot of detail, and he talks about a lot of. I think he would cover this. I don't know of a book that would cover it better. Maybe there is a better book out there, but I don't know of it if it will. The thing is beyond the book. Actually, something like New Retirement would be perfect for you, or if you want to do the work yourself in a tool. Or hiring an advisor to put basically here's what an advisor is going to do. I don't mean to manage your investments, but to answer some of these questions. They're going to use something like New Retirement. They're going to either use, most likely, eMoney Advisor or Money Guide Pro, which are two applications that are available only to like certified financial planners. They don't market them to lowlifes like all of us. So you got to go through an advisor. But so you could do that, and they're going to be able to help you answer these questions. But the thing to keep in mind, though, is it's not a magical solution. These tools, including New Retirement, that we'll look at next week, because a lot of them you have assumptions. Like take RMDs for example, and you're 69. So let's say they start at 72. So you're close. So the assumptions. The impact of getting assumptions wrong may not be as great as for someone, say, my age, who's younger. But how the market performs. If the market, let's say your traditional retirement accounts are down between now and 72, down by 50%. Your RMDs are much lower. What if it's up 30%? Well, they're much higher, and who knows what's going to happen. So I say that because these tools I think are great. They're the best we have, but they're still totally dependent on a host of assumptions. But yeah, that book, good book. That might, I think, help you. Lisa, what is your stance on using your cash to pay off mortgage prior to retiring, or use it to buy in low now? I will have a pension in retirement. Well, the first thing that jumps out at me is your statement about buying in low now. Here's my question for you. How do you know it's low now? We know that it's lower today than it was yesterday, particularly in my bank stocks. And it was lower than it was the beginning of the year. But we don't know. Is this the low water mark? How do we know? We don't know. And in fact, I would expect it to go lower generally as a trend. What it does tomorrow or next month, I have no idea. So having said that, one of the things when it comes to paying off a mortgage, so a mortgage, and again, depends on your specific circumstances, but I'm assuming you have a very low rate and it's fixed. Those are big assumptions. But if you do, one of the things when I was working on paying off our mortgage, one of the things I never wanted to do was sacrifice liquidity. I wanted to make sure I always had enough money to handle the unexpected. The last thing I wanted to do was pay off a mortgage only to run into problems and then need to borrow money at higher rates, in shorter terms. I mean, because a mortgage is probably about the best loan you can get, right? So that was like sort of the first thing I wanted to make sure I'd taken care of it. And then I wanted all my other financial goals to be met. Kids' education, saving enough for retirement, whatever, before I started paying off the mortgage. Now, if you have all that, you got plenty of liquidity, all of your financial goals are met, then it may make sense to pay off your mortgage. You say you have a pension, so that how much of that, and maybe Social Security, does that cover 100% of your expenses? 50%? I mean, these are all important questions. So I can't give you an answer. What I can do is
something went wrong. Try again in a few seconds.
I think that was Siri talking to me again, but this time it didn't scare me as it normally does. These are just questions that need to be asked, in my view, in answering this question. I do think all other things being equal, yeah, it'd be great to have your mortgage paid off as you enter retirement, but there's no rule that says that has to be the case. And there are trade-offs, as you know. Obviously, you're giving up a lot of money. Now, if you're near retirement and your only question is, do I pay off the mortgage or put it in the stock market? Personally, everything else is taken care of. I personally would probably pay off my mortgage. That's what I would do. Well, that's what I did. So, but a lot of factors go into that. All right. Jack, I appreciate your comment, but that was so long ago, I don't think I could find that comment. So there's just no way I'm going to find it. I'm sorry. Okay, John, I hear the term, the market is overpriced. I assume that is relative to PE or some other metric. If that's true, how much of a sell-off would the market have to experience to get to normal? It's a great question. Well, let me show you something. So this is, well, that's interesting. Yeah, we've had a sell-off. So here we go. This is from multiple multpl.com. This is the PE of the S&P 500. And depending on where you're going to look at it, you're going to get slightly different numbers. But this is the history. So if you come down here, the mean, median, we'll call it 15. Just for, you can see it down here, but the mean, I'll call it 16. So, we're at 24, right? So we're still well above, you could see what, 35% further correction? I'm just spitballing it there. But here's the thing to keep in mind. One of the things missing in this picture, what is it? Interest rates, right? You can't look at valuations in in a vacuum. As interest rates go lower, valuations go higher. Oh, yeah, there's other factors, of course, that go into valuations, but I mean, generally, interest rates, lower rates support higher valuations, higher interest rates support lower valuations. By the way, no different than bonds. This isn't even, it's not even a point about stocks. It's really a point about assets. I mean, if you think about it this way, I mean, you can think of it two ways. One is we always have a risk-free investment option, U.S. government bonds. And so if we're going to take risk beyond safe U.S. bonds, we want to get a premium, right? We want to get something in return for the risk we're taking. We're going to demand a higher expected return. And so, but when U.S. government bonds are paying so little, well, we don't need a whole lot more, and we're better than the bonds. Now, imagine that we snap our fingers and they're 10%. Well, what's going to happen? We're going to expect more return out of our other assets. How are we going to get those? Lower prices, right? If I can get 10% guaranteed from a U.S. government bond, that's where my money's going right now. And so what would happen? Stocks would go down, and asset values generally would go down. The other way you could look at it is discounted cash flow analysis, and you might use the long bond or 10-year bond to discount future cash flows. And so the lower the rate, the higher the valuations. But in any event, so this doesn't factor in interest rates. But yeah, we certainly, I mean, if we think about it just in terms of historic valuations, we could easily go down. And by the way, getting to like 16 just gets us to the mean, according to right here, right? I mean, look at, well, the low was 5.3. That would hurt. It was 1917. Yeah. There you go. This is not exactly the feel-good show of the year. Brian wants to know that if I had a 50-50 portfolio during the 2008 crash, 1 million would have dropped to 80,000. That doesn't sound right to me. That's not right. That can't be right. You mean it would? That can't be right. If you are used to pulling 40K, you would bump up to 5% withdrawal rate. Doesn't seem that bad. Scary. Flawed logic. Well, it wouldn't drop to. It just wouldn't drop to 80,000. But we can model this. Yes, I don't think it would. Right. So let's do. We'll just use asset allocation. We'll do. You said a 50-50, right? Okay. So we'll do U.S. stock market 50%, and we'll do. We'll just use. U.S. bond market, 50%. We'll start it in, we'll start it in, I guess this would be January of 2008, right? That's what you said. Yeah, 08. Okay. We'll start with $1 million. We're going to withdraw a fixed amount of 40,000, right? Well, yeah, you said you bump up to 5%. We'll adjust that for inflation. We'll withdraw annually, rebalance annually. Leverage type. I haven't seen that before. Huh. Anyway, should we give this a name? Custom. All right, let's give it a name. Yikes. All right. And we analyze the portfolio. So yeah, we did okay. We've been retired for about 14 years, give or take. We've been taking out more and more each year because of inflation. Not a lot more. We've got 1.5, almost 1.6 million bucks. So that's pretty good. Our total value, it didn't go down to 8. Maybe you mistyped, or maybe I don't know. In any event, our yikes portfolio, the low watermark, 724,000. I don't think I'm missing any assumptions in here. By the way, fun tool to play with if you're at that age where this matters. Okay. I will say that right now, to me, from a retirement perspective, I'm more concerned about today than I would have been in 08. And well, yeah. And the issue right now is inflation. And when you think of the worst time to retire in the last 100+ years, it would have been in the late 60s. And sure, there were bad markets in the 70s, 72.3, I think, or 3.4. But in any event, the big issue actually wasn't the declines in the market. Eventually, they corrected. The big issue was inflation, because if you're adjusting your withdrawals each year by inflation, that number gets bigger and bigger and bigger. And if we've seen some pretty significant inflation. Of course, that doesn't mean you have to adjust by inflation, but then you're spending less on a after inflation basis. So, I mean, when I say I'm more concerned, I'm not lying awake at night. But and I do suspect that inflation, I think it'll get worse because of what's going on in Ukraine. But I still, if I'm guessing, I'm terrible at this, but if I were guessing, I do think it'll moderate. Maybe I'm just hopeful. All right, greetings from South Carolina. Hi, in running my asset percentages, I see that I am less than 1% away from needing to rebalance using the guardrail method. I know that the bottom is not near for equities, but should I rebalance or wait? Well, we don't know if the bottom is near for equities. I guess maybe it's not. I think the best approach is to have a rebalancing plan that's objective. It could be once a year. In your case, it's when you hit certain guardrails, and I would personally rebalance. The only thing that would keep me from rebalancing is if there were some sort of nasty tax issues, and I might skirt that a little bit if there were some nasty tax issues. But in my case, I think I've avoided that. I think. I try to avoid making investment decisions based on what I think the market or interest rates will do over pick a period of time. That's my approach. Yeah. All right. Well, Josh, please explain ways to sell tips in the secondary market. Thanks. Well, do you own individual bonds? I mean, I've only owned tip funds, and you sell them. Right? I mean, either if they're mutual funds, you sell them back to the mutual fund company. If they're ETFs, you sell them like you'd sell stock. I've not dealt with individual tips. You can buy them, right? Let me see something. I wonder if you can sell them back to the government. Can you sell tips back to President Biden? It's not what I typed. The first thing that comes up is 3 reasons to maybe avoid tips. Not helpful. Well, here we go. There you go. There's your answer. Well, a answer. This is Treasury Direct selling Treasury tips. So, and if you own individual tips, I'm guessing you bought them through Treasury Direct, but I don't know. I've never bought individual tips, but you could Google Treasury Direct selling Treasury tips. You'll find this. That might be helpful to you. David, where do you recommend putting emergency reserves? So savings accounts, M1 has 1% APY. It's interesting you asked that. I got an email from someone who looked into Axos Bank, which I've mentioned. They pay 61 basis points on savings accounts, but there is limits. It's only up to like 24,999. They ended up going with Marcus, which has much higher FDIC limits, and I think it's 50 basis points. You mentioned M1. So M1 does pay 1%, and it's for a checking account, I think. I'm pulling it up. But you do have to be a member of M1 Plus, which I think is $125 a year. But if you have enough in there, it could very well be worth it. I'm going to pull this up for you. The one thing I don't know, well, look at that. You get a bonus. 1%. Here it is. I don't know how well you can read that. Let me try to make it bigger. I always like when they say things like 33x the national average. Yeah, the national average is 0. What I don't know here is, let's see, maybe this will tell us. I was looking to see if there's a limit to how much you can put in there. And there might be, I just don't know. You do have to get the 1%, you got to have M1 Plus, right? The other option, by the way, is I think SoFi. Aren't they at 1%? Yeah, here we go. 1% APY. Banking is here. No account fees. Now, see, you see that right there, that little one? That's what we got to figure out. Where is it? Here it is. Remember, the big words giveth, the small words taketh away. SoFi banking members with direct deposit can earn 1% annual percentage yield APY interest on the first $50,000 of their balance for the checking and savings accounts, plus the cumulative total of vault balances for up to 150,000 total deposits. Yeah, so there you go. Those are two options. I don't have either of them, by the way. All right, I've got time for like one more question. It's 8:28. Brad mentions doing an Airbnb as an investment can be a lot of fun, good way to meet a variety of people, and you make more than the long-term rentals. That can be. I had someone that used to work with me. She and her husband actually did an Airbnb of one of the rooms in their house. I don't know if they maybe set it up in some way that it was sort of separate, but it like helped them pay off their mortgage. I'll do one more. Paul, deciding, I think you may have emailed me. Yes. Anyway, deciding on stock allocation between Social Security, $110,000, it looks like real estate, dental building, I think. I'll need less than 1% of the portfolio. What would you do stocks to bonds? I mean, I would probably be around 80-20, which is kind of where I am right now. Now, I've thought about going to 70-30 once I actually start drawing down, but I don't know. If I literally had no other income, I would probably be at 2%-ish of our portfolio, maybe. Well, that's not true if I factor in Social Security. But in any event, it sounds like you and I are in similar situations. And, if you look at historical data, 1%, I mean, you could live to be 1,000 and you'll die with a lot more money. Or Bitcoin, whatever we're spending in 1,000 years. I don't think it'll be Bitcoin. Than you started with. I mean, 1%, right? I mean, if you think about a perpetual withdrawal rate where you take what can you take out, what percentage adjusted for inflation such that your starting balance not only doesn't go down, it actually goes up and stays up with inflation. And that comes in around over enough time, like 3.5%. Now, of course, that number could be lower if we have worse conditions going forward. But boy, 1%, Paul, I mean, it's a good place to be in. I think you could do take a lot of different approaches. Josh says, good evening from the Great Lakes, Illinois. What did you think of the Duke versus UNC game? I didn't see it. Duke lost, right? It was Coach K's last game, right? I mean, did I hear, I think, right? Yeah. I didn't see it though. I know they lost. I guess this is regular season, right? 94-81. I bet it was a great game, but yeah. I'm not really a college basketball. I mean, I'll watch some March Madness. I don't even do the brackets anymore. I'm terrible at it, by the way. Terrible. Like if they had a prize for like the worst bracket, maybe they do. Maybe that's what I need to sign up for. Part of my problem is I always put Ohio State winning the whole thing. So there's that problem. And of course I have Michigan losing in the first round. Sometimes I get that right. Sorry, VJ. Well, that's it. It's 8:31 and I'm tired. This is like my bedtime. I'm old. Hey, as always, I appreciate you guys watching. You guys have great questions. I hope some of my answers are helpful. I do my best. Next week, I think I'm gonna do the new retirement thing, but again, we can talk about it as we go through it and talk about the issues, not just the software. And in fact, in some ways, the software might help us sort of see visually what's going on in a whole planning for and then living out in retirement, and talk about the questions that it raises. Yeah, maybe. So if you have it, you want to try. I think they have you can try it for free. I think. You can follow along, do your own plan. You don't. And by the way, while you can connect your investment accounts like you would with, say, a personal capital, you don't have to. And in fact, it's really not necessary with new retirement, because new retirement, personal capital like shows you your asset allocation and your fees for all of your investments. That's not what new retirement does. So I don't connect my accounts to new retirement. I set them up and just put the balances, and you'll see that next week, not mine, but a demonstration of it. So you don't even have to worry about connecting your accounts if you don't want to. So the other thing, before I go, on connecting accounts to anything, a lot of the brokers now are not opening up their data to connect to banks or to personal capital or whatever during business days, business hours, because of the traffic on their data. They just don't want it pulling. So if you were like all excited to sign up for whatever app that you're going to connect to something, and it's during the weekday, you're very likely not going to be able to connect it until the evening. Just thought I'd mention that. Yeah. All right, gang. Thank you as always. I hope you have a great week. I will be back Thursday at 11 a.m. Lord willing, and the creek don't rise. Until then, remember, best thing money can buy is financial freedom.